and he'll be taking us through some of the key elements and key scenarios that one needs to keep in mind when planning ahead. Chris, thank you very much for your time this afternoon.
Pleasure.
You know, we keep talking about a double dip scenario and the chances of a double dip scenario increasing at this point in time. A lot of concern coming through on that front. How does one take this concern and filter it into a strategy for investing?
Well, I think the first thing is to understand what a double dip means. A double dip means a second recession. That's, of course, even if we exited the first one, but a second down dip in the economy into recession. And that actually is for your developed markets, the US, UK, Europe, Japan, etc.
Your view that we're going to get into a double dip?
I do believe that those countries are heading for double dip, because I think part of the measures that have been taken are part of the problem, not the solution. Balance sheet depleting methods when you start to quantitatively ease, etc. It does mean then the emerging markets will be affected, but you'll probably see those economies muddle along. So we're basically balancing between a recovery scenario, a muddle along, and double dip. Those are basically three scenarios, but in effect they're interlinked, because double dip scenario means a muddle along for the emerging market. If you see a full recovery, for instance, it'll be in emerging markets growing strongly, it probably muddle along for the developed world. That's the kind of thing that one needs to be thinking of. And then the financial markets, how do they particularly perform? One of the things that I think we need to be thinking of is that in the first round, you saw what we call this risk aversion trade coming through. In other words, you close your eyes and they just sell risky assets, that's emerging markets, etc., and pull it back to US Treasuries as your safe haven asset. Now, I do believe in round number 2, especially with the methods, the quantitative easing that's taking place, round number 2 is going to be problematic, and that you may well find that that with differentiation starting to take place, right, you may find the actual flow of capitals is very different in the second round. We saw that with the emerging markets, for instance. Round number 2, you just saw it cascading through emerging markets indiscriminately. Round number 2, when the Brazilian crisis hit, the South African rand actually improved during that time, because it was starting to be differentiated in ring fences. That is a Brazil-specific problem. If we want exposure to emerging markets, you sell out of Brazil and allocate that money, some to Brazil, some to Turkey, etc. And so when the Turkish and other problems hit, it was a lot more contained. And so in the next round, when you start to see the differentiation, the countries that are in trouble will be sold off, and the countries that are strong will actually do quite well. So even within the developed world, countries like Germany and Canada and Switzerland doing very well, because they seem to be the stronger of the developed world, and your stronger emerging markets also doing well. China, India, Brazil, obviously candidates, but your second tier, as it were, Indonesia, Vietnam, Colombia, what they call the civets, coined there, also South Africa included there, doing reasonably well. Even though we'll be hit hard, I call our economy a muddle along, but our stock market could do quite well during that particular time, and the rand remaining reasonably strong.
And of course, we did see in the last recession, or when the financial crisis hit, we saw money going out of all markets. So
yes,
the JSE really copied what was happening there on Wall Street. Right. But I mean, as US investors try to cover their losses, aren't they still going to take money out of emerging markets?
And that means that you'll find emerging markets will still struggle, but they will be outperforming the developed market industry.
So we might not fall to the same extent.
The MS, whereas the first round we fell more than the developed world, because the effect of that capital withdrawal will be greater. But remember, round number 2 means greater amounts of stimulus, in other words, wider budget deficits and more quantitative easing. You've got more pregnant capital sitting there, stagnant with no yield, no growth, and I think that's where you'll see the differentiation taking place, that you'll start to see that money looking for growth and yield, which will be in your emerging markets. So it's not a slam dunk that you'll see the same pattern that you saw in the first round in the second round.
Well, you know, some would say that we need fiscal consolidation on a global level and that most, central banks are running out of bullets.
Yes.
We're talking about stimulus here, and we're also talking about quantitative easing. And when you look at the South African scenario that is playing out, you know, we're really at the mercy of the likes of China and many other developed worlds for our growth and also for the demand of our commodities. Yes. So you're saying that we're not going to get affected as badly, but, you know, because we've also got to look at the greater macro picture and how we are at the mercy of many of these other markets.
Exactly. Remember, we've got some internal growth dynamics as well. That, in other words, that the actual structural problems that are reflected in the US, UK, and the developed world are not the same here. We do have some similarities, but the burden of government isn't as great as it is in Europe, for instance, and Japan. On the economy, we do have some relief here. South Africa sits in a little bit in between emerging markets and the developed world in many instances. And so that's why I think South Africa might underperform countries like India and China, but still outperform countries like the UK and France.
Because our real interest rate currently sitting around 2.8%.
Yes.
That could fall to 2.3% next week if we do get that interest rate cut. Is 2.3% still attractive enough for that money-chasing yield?
Yes, but I still don't believe that yield-seeking flows are dominant in South Africa, and that we can see that the rand strengthens on cuts and weakens on hikes.
It's chasing growth as well.
Because it's the growth-seeking funds as well, which dominates South African capital flows, but it tends to dominate emerging market capital flows as well. The currency is too volatile for the yield seeking to dominate, because the currency volatility overwhelms the yield pickup that you do get. And that's what I think one of the reasons why. But growth is the reason why people invest in emerging markets.
Bond market has been basically outperforming all other asset classes here in South Africa. Some are saying that this is perhaps a warning signal.
It is a warning
that we
signal.
need to be a little bit concerned. Things looking slightly overheated, benefiting from hot money and less money going into equities. How are you playing that?
But I still think, you know, in nominal and real terms, that our bond yields are still offering more than most bond markets, even though it may be overheated, you know, in our own context. The bond markets around the world are suggesting there's going to be a slowdown, and you know, none more than the US and German yields that have been coming down.
Let's look at asset allocation then, Chris. I mean, looking at the bond market versus hard assets, and also looking at the equity market, because you're not that bearish on South African equities, it sounds.
Not that bearish, but one needs to bear in mind that I think we're going into different phases. If we have a look at markets over a long period of time, you'll find the 60s and 70s, for instance, the main source of return was in fact dividends. It wasn't capital growth, right? Whereas in the 80s and 90s, your biggest source of return was in fact in the capital growth side rather than dividends. And I think we're going back into that world where the index might go into the wilderness for a long time. In other words, you don't get much pickup on the capital side, but you'll get the pickup on the dividends. So dividends are going to become a lot more important in the years ahead. So that will be a very important part of a portfolio, is what is the dividend yield and the growth potential of that dividend.
If you look year to date, equities are actually marginally weaker, down 0.1% year to date. Of course, we have bonds outperforming, up by anything between 13, 14, 15%, depending which one you're looking at. We have seen some companies increasing their dividends lately. Of course, so we had Anglo American resuming its dividend, and we've had a number of other dividends being resumed. We've had growth in dividends, even though earnings might be under pressure. Why do you think companies are stepping up these dividend payments in an uncertain environment like this?
Well, I think if you're going to get investor support effectively in what investors see as the dividend, they don't see the earnings, they don't see anything else. And a lot of companies, pension funds, etc., can't invest in companies that don't pay dividends, for instance. It's and consistency and reliability of that dividend is actually quite important. So I think companies that are doing that are recognizing that their shareholder base, right, is in fact quite dependent on those dividends and are prepared to actually step up to the plate. Those companies, funnily enough, will become, will continue to be reliable because they are actually, being good custodians of their assets on behalf of the shareholders.
Chris, you've also been one of the people that have been concerned about the quantitative easing and all the stimulus, and you've cited inflation as one of the concerns down the line, and clearly it's going to be far down the line. What about hard assets? Just looking at the likes of gold, because I know that you are a fan.
I am very much a case that in this kind of world you'd want shares that pay dividends and reliable on that side, but your hard assets such as gold will also be important, because while authorities are still debasing their currencies and running huge deficits and looking at that as a solution, your hard assets need to be a backstop. Once they stop doing that, in other words, you get conditions like at the beginning of the 80s, you'd say, okay, fine, then the need to actually hold hard assets will then fall away. But in the meantime, you need to actually hold them. The inflation will come, and it won't necessarily come from a demand side. It may well come from a collapse in the demand for a currency, and that's the problem that Zimbabwe had, etc. All the hyperinflationary events is when you actually have a collapse in the currency, not because demand exceeded supply.